Hello and welcome to SKANS Ecampus. SKANS Ecampus is a gold-approved learning partner of ACCA. On this channel, we bring you demo videos of different courses available at SKANS Ecampus. So don't forget to subscribe to our channel to get notifications of additional videos and hit the like button.
In this lecture of IAS 8 Accounting Policies, Changes in Accounting Estimates and Errors, we are going to see the last part over here in the name of the standard, that is errors. First of all, we need to understand what errors are, and then we are going to see how they are accounted for in the financial statements once they are identified. So starting off with the definition, with respect to the prior period errors, the standard says that if there are any omissions or misstatements in the financial statements. Now please see over here, the word is omissions as well as misstatements. So if you are talking about an unintentional error, that is also going to be covered over here in the name of errors in this standard. And if there is a deliberate misstatement, which means that if there is a fraud in the financial statements, that is also going to be accounted for under IAS 8. So now over here, the standard says that prior period errors are omissions and misstatements in the financial statements of one or more prior periods arising from a failure to use reliable information that was number one available when the financial statements were authorized for issue. So we knew it beforehand, or we were not able to identify it, but it was there in the business at that time. And also it could have been obtained and taken into account in the preparation and presentation of financial statements. So if the complete accounting had been done, proper tracking of transactions had been done, this would have already been identified. But it was not identified, or it was deliberately left out like a fraud, then that is called a prior period error, and that is accounted for under IAS 8. Another very key definition over here is of the word materiality. Now when we say materiality, it is the omissions and misstatements of items. Once again, omission can be by chance, by mistake. Misstatement is something deliberate. So omissions or misstatements of items that could influence the economic decisions of users. We have studied the concept of materiality in the conceptual framework also. It means that at times there are errors or there are misstatements, but they are of such small nature with respect to quantity or quality that they do not play a significant role in the economic decision making of users. Over here, in case of materiality, we are talking about items that are that important. They are that major that they are going to impact the economic decision making of users. How does the materiality link to the errors and frauds? Let's see over here. IAS 8 says that you have to correct material prior period errors retrospectively. So this is a very major thing, that when you identify a mistake or a fraud. Please remember over here, we are talking about both errors and frauds, because that may be given in your exam question, that the error took place 3 years ago, some portion of it took place in the current year, or the fraud has been happening in your business for the past 3 years. So some portion of it relates to the previous years, some relates to the current years. So the standard over here says that if there are any errors which are material, it can be with respect to quality, it can be with respect to quantity of the error. So if there is an error, then you have to correct it retrospectively in the first set of financial statements authorized for issue after the discovery. So there are 2-3 key points in it. First of all, the error needs to be material. Then its adjustment needs to be made, but that has to be done retrospectively. We have covered in the changes in accounting policies what do we mean by the word retrospectively. So we are going to correct it retrospectively in the first set of financial statements. So retrospectively means that you not only have to correct the working of the current year, in fact you have to go back and correct the accounting of previous years also. So in this case you have to make the adjustment retrospectively, and the retrospective adjustment needs to be made in the very first set of financial statements which are being authorized for issue or which are being made after the discovery. So as soon as the fraud or error is discovered, you have to adjust for it retrospectively if it is a material error. by number 1, restating the comparative amounts for the prior periods. This is exactly what we have covered in the accounting policies also with respect to retrospective adjustment, that first of all you have to restate all the previous amounts also, and if the error occurred before the earliest prior period presented. So if the company presents, for example, 2 years comparative financial statements, then in the earliest prior period presented, you have to restate the opening balances of assets, liabilities and equity for the earliest prior period presented. Now over here, please remember that when you talk about adjustment to opening balances, this adjustment needs to be made against the opening balance of retained earnings also. So the accounting treatment is exactly like what we have covered in case of changes in accounting policies also. You need to remember the correlation that will make it easier for you to remember the accounting treatment. So now in your exam question also and practically also in life, you have to first identify the error that is taking place. Then you have to see whether the error or fraud has taken place in the current year or it took place in the prior years. If it took place in the prior years, then you have to restate the amounts of the comparative financial statements also. You have to make a retrospective adjustment in this regard. Over here also we can see the summary of accounting treatment that needs to be done. If there are any prior period errors or frauds, then you have to do a retrospective adjustment, and that has to be made in the opening balances of the statement of changes in equity. And if there is a complete fraud or error in the current year, or at least a portion of fraud or error is happening in the current year, then you have to make its adjustment in the current year financial statements. So over here also you have to identify if, for example, there was an issue with the collection of receivables. So we have seen in the past exam papers also some of the examples where they said that the accountant ran away after taking money from the receivables. The receivables are still outstanding in our financial statements. So definitely speaking, the customers have paid the money. They're not going to pay it again. From our point of view now, it is our irrecoverable debt. So we have to adjust it in the financial statements. If this happened in the current year or the relevant portion for the current year, that is going to be adjusted mainly in the statement of profit or loss as an expense in the current accounting period. On the other hand, all the relevant heads are going to be adjusted. So if we are talking about the receivables expense, on one hand, the P&L needs to be adjusted. On the other hand, the balance of receivables needs to be adjusted. If that happened in the prior periods, then the expense would have been adjusted in the retained earnings opening balance in the statement of changes in equity, and on the other hand, the balance of receivables would have been adjusted. So you have to see in the question when the error or fraud took place, and you have to make the adjustment accordingly. In one line, if the examiner asks you that what is the accounting treatment of errors and frauds under IAS 8, you have to say that they are going to be adjusted retrospectively. This is all with the accounting treatment of errors and frauds under IAS 8. Thank you.
If you like this video, visit our website www.skansecampus.com to purchase the complete course at affordable prices. Register today at no cost and access our free 10-day trial.